Welcome to the deep dive. We're here to take complex financial documents, things like investor letters, and really pull out the key insights for you.
And today we're digging into a really interesting one, the 2013 annual letter from Terry Smith at Fundsmith.
Exactly. It's from the CEO to the owners of the Fundsmith Equity Fund. And look, this isn't just some dry report. It's often seen as, well, a master class in investment thinking.
Definitely. Smith is, widely respected.
So our mission today, let's unpack this letter. We want to understand Fundsmith's approach. Maybe find some surprising facts and see what enduring lessons there are that you can maybe apply to your own thinking.
Sounds good. Where should we start? The performance.
Yeah, let's kick off there. Okay, let's unpack this.
So the headline numbers for 2013, the Fundsmith Equity Fund, specifically the T-Class accumulation shares, they delivered a total return of plus 25.3%. That's net of fees.
Good. 25.3%. How did that stack up against the market?
Well, it compared pretty favorably, actually. The MSCI World Index returned plus 24.3% in sterling with dividends reinvested.
So basically, they outperformed by 1%.
Exactly. A crucial 1%.
Yeah, that 1% outperformance is, well, it's pretty interesting, especially when you hear the fund's portfolio described as defensive.
Right.
But here's where it gets really interesting, I think. The letter calls 2013 a game of roughly two halves for the stock market. What exactly happened there? What made it so distinct?
Yeah, it was quite a ride. So the market, measured by that MSCI World Index, it shot up sharply, 19.1% just between January 1st and May 22nd.
Wow. Okay. Big jump.
Huge. But then things changed. Federal Reserve Chairman Ben Bernanke hinted that the Fed was thinking about tapering its quantitative easing program.
The infamous taper talk.
Yeah.
Slowing down the money printing, essentially.
Basically, yeah. Slowing down the massive bond buying stimulus. And as soon as he mentioned that, boom, the market fell 9.4%.
So this brings up that phrase in the letter, the perverse aspect, where good news is bad news. I mean, normally signs of economic recovery would be good for markets, right?
You'd think so.
Explain that a bit more. Why was potential good economic news seen as bad by the market then?
Well, this is, I think, a really important point. The market wasn't actually cheering the idea of economic recovery, especially in the U.S. and U.K.
Really? Why not?
Because it was terrified that recovery would mean the Fed would withdraw the QE stimulus. That stimulus, had pumped an estimated $4 trillion into the system,
Yeah.
a lot finding its way into emerging markets.
Okay, I see. So the fear of losing the stimulus crutch outweighed the optimism about the economy getting better.
Precisely. It completely flipped the script. Good economic news meant the stimulus might end sooner, which the market saw as bad news. It shows how much QE was distorting things.
And in that second half of 2013, you saw that shift play out in sector performance too, didn't you?
Absolutely. Sectors like consumer discretionary, industrials, finance, IT, energy, they did really well.
Sectors Fundsmith generally avoids.
Exactly. Meanwhile, consumer staples, which is, the bedrock of their strategy,
Yeah.
they were among the worst performers in that period.
Ouch. That must have really tested their conviction and their philosophy, right? Holding on to staples when cyclicals were flying.
Oh, I'm sure it did. But despite these market shenanigans, as Smith calls them in the letter.
Hey, shenanigans.
Yeah, the letter really emphasizes that their investment method didn't change one bit. They state very clearly, we don't time the market, we don't switch into cyclical stuff based on forecasts.
So sticking to their knitting.
Completely.
Hmm.
Their commitment is always to be fully invested in what they see as high-quality companies that meet their very specific, exacting criteria. And they stress this is based on financial performance going back potentially many decades. It really shows that long-term view.
Okay, so let's move from the big picture market stuff to the actual companies they held. The letter breaks down the top and bottom 5 contributors for 2013.
It does. So top contributor was Domino's Pizza, added just over 3% to performance.
Domino's, okay. Who else was up there?
Then you had Microsoft, Stryker, Becton Dickinson, and 3M, all positive contributors.
Right. And on the other side, the bottom 5.
Well, interestingly, only one stock actually had a negative contribution for the year. That was Swedish Match, down just minus 0.06%.
Only one negative. That's pretty good.
Yeah. The other 4 in the bottom 5, Serco, Imperial Tobacco, Schindler, and Philip Morris International, they still contributed positively, just less than others.
Okay. And what's the story behind some of those weaker performers, like the tobacco names?
Well, yeah, 3 of the bottom 5 were tobacco companies. The letter mentions concerns around plain packaging regulations and the rise of e-cigarettes impacting them.
But Smith thought those concerns might be overdone.
That's what the letter suggests, yeah.
Yeah.
Though it also notes they have self-imposed limits on how much they'll hold in any one sector, like tobacco.
And Swedish Match, the only negative one.
Interestingly, that was a company they actually started buying during 2013 because its share price had weakened, making the valuation look more attractive to them.
Ah, okay. Now, speaking of buying and selling, for a fund that famously, or perhaps infamously, preaches the virtue of doing nothing.
Now, they actually sold 5 holdings in 2013. McDonald's, Schindler, Serco, Sigma Aldrich, and Waters Corporation. That sounds like quite a bit of activity for them.
It does seem like it, doesn't it? Especially given the do-nothing philosophy.
So how do they square that? How does the letter explain these sales?
Right, it's a fair question, and it gets to the heart of what do-nothing actually means for them. It's not literally nothing. They aim for minimal turnover, and the letter actually reports a negative turnover of minus 17.6% for the period.
Negative turnover. How does that work?
It's a bit of an accounting quirk.
Yeah.
It basically means the total value of the shares they sold during the period was greater than the average value of the fund's assets. It doesn't mean they were shorting or anything, just reflects the value of sales relative to the fund size.
Okay, got it. But still, 5 sales. Why McDonald's, for instance?
Yeah, so for McDonald's, the issue wasn't just valuation, it was poor underlying sales performance despite them being quite aggressive on pricing.
The concern, reading between the lines, was that it was maybe becoming a business that was selling solely on price.
Yeah.
Which is something Fundsmith actively tries to avoid. They want companies with pricing power.
Makes sense. So they kept Domino's for that franchised fast food exposure instead.
Exactly. They still like the model, just not McDonald's execution at that time.
Okay, that's McDonald's. What about the others? Schindler, Serco, Sigma Aldrich, Waters. Why were they sold?
Right. Schindler, the elevator company, was apparently sold simply because its valuation got too high, too expensive. But they kept exposure to that sector, which they like, through their holding in Cone.
Okay, so valuation discipline there. What about Serco? That's the outsourcing company, right?
Yeah. Initially, it seemed to fit their model, lots of everyday repeat transactions, like managing public bike schemes or, prison transport, small, repeatable stuff.
Right.
But concerns grew around the risks associated with its really large government contracts. And also, an acquisition they made seemed to negatively change the company's cash flow profile and capital intensity.
And those concerns were later proven right, weren't they? With things like the electronic tagging scandal.
Exactly. So Fundsmith got out before the worst of that hit. Then Sigma Aldrich, the lab supplies company.
Why sell them?
That was triggered by Sigma's attempt to buy a much larger and what Fundsmith saw as a risky business life technologies.
A big acquisition attempt.
Yeah. And the letter makes a great point here. Smith says with low turnover, they're essentially trusting the management of their portfolio companies to allocate capital wisely. So when a company proposes something huge and potentially risky like that,
They get nervous.
they get nervous. He says they have a strong impulse to run away.
I like that phrasing, run away. And finally, Waters Corporation.
Waters, the scientific instrument maker, that was sold partly due to fears that a slowdown in emerging markets could hit its equipment sales, which can be quite cyclical.
Okay.
And also, it was the only stock in their portfolio at the time that didn't pay a dividend, which made them question whether it really had sufficient opportunities to reinvest its cash profitably.
So, again, quite specific reasons tied to fundamentals or strategy shifts in each case. It wasn't just random trading.
Precisely. It shows that do nothing means avoiding unnecessary activity, but not ignoring fundamental changes in the businesses they own or their valuations.
Right. So they sold 5. Did they buy anything new apart from starting that Swedish Match position?
They did. They bought CR Bard.
Okay, what do they do?
It's a medical device company, but focused more on consumables, things like catheters, vascular products, stuff that gets used up and reposed.
So less reliant on big, infrequent hospital equipment purchases, what they call lumpy capital expenditure cycles.
Exactly. And it benefits from the aging population trend.
Yeah.
Steady, repeatable business.
Makes sense. Anything else?
They also mentioned they'd started buying shares in an undisclosed transaction services company, but hadn't finished building the position yet, so they didn't name it.
Okay. Now, let's pivot to maybe the biggest question that the letter tackles, something investors were clearly asking in 2013.
Which is,
have these kinds of high-quality companies, the sort Fundsmith invests in, become too expensive?
yes, the valuation question, always a big one.
And it was particularly relevant because, as the letter points out, a lot of the fund's 2013 performance came from rising valuations, multiple expansion, not just underlying business growth.
That's right. They even include this quite charming hand-drawn chart showing the S&P 500 price was up 30% in 2013, but the underlying earnings per share, the EPS, was only up about 6%.
Yeah. So most of the gain was people paying more for the same earnings. How did Fundsmith view that? Were they worried?
Well, their perspective is really interesting. They directly attribute those rising valuations to the massive injection of liquidity from QE and a sustained period of zero interest rates.
So central bank action puffing up prices.
Pretty much.
Yeah.
But they also caution that these valuation changes, this re-rating, it's finite. It can't go on forever, even if QE continues for a while.
And they warn about the future.
They explicitly state, and this is a direct quote, "We will have to live through some character testing times when they are withdrawn," referring to QE and zero rates.
Character testing times. That sounds ominous. It raises a big question for you listening. Are you actually prepared for those times?
It's a crucial question.
So, given this backdrop, how does Fundsmith actually think about valuation? How do they decide if a price is acceptable?
They offer 6 different ways to look at it in the letter. First, and this is key to their approach, they focus on free cash flow yield.
Right, FCF yield, not the more common price to earnings or PE ratio. Why is that?
Because, as they put it quite bluntly, not all E's or earnings are created equal.
Meaning?
Meaning reported earnings, the E and PE, can be fiddled with through accounting choices or include non-cash items. Free cash flow, on the other hand, is the actual cash the business generates after all expenses and investments. It's harder to fudge. It's the real cash available to owners.
Okay, so they prefer FCF yield. What level do they look for?
They aim to buy when a company's FCF yield is roughly at or maybe slightly above what you'd expect from long-term government bonds, plus about 1% to account for expected inflation, kind of a real return target.
And where was their portfolio's FCF yield at the end of 2013?
It was 5.1% on a weighted average basis, which they note was still comfortably above their acceptable level and also looked pretty good compared to the median FCF yields of the S&P 500, which is 4.6%, and the FTSE 100 at 4.0%.
And crucially, were those cash flows growing?
Yes, they point out their portfolio companies grew FCF per share by an average of 6.6% that year. So decent yield and decent growth.
Okay, that's a really clear framework on FCF yield. What were the other ways they looked at valuation?
Well, secondly, they pushed back against the narrative that consumer staple stocks were more expensive than ever.
Which you heard a lot back then.
Constantly. But they pointed out that staples were actually rated more highly on valuation multiples back in the 1990s. Plus, staples were less than half their portfolio anyway, and some of their medical tech stocks were actually trading near the low end of their historical valuation ranges. So it wasn't a uniform picture of expense.
Interesting context. Now, this next point you mentioned from the letter, it really challenges conventional thinking. It's about the power of compounding.
Ah, yes. This is, for me, one of the most powerful parts of the letter. It connects directly to that valuation debate.
So what's the example they use?
They look back at Coca-Cola and Colgate-Palmolive from 1979 to 2009, a 30-year period.
Okay.
And they ask, what if you'd bought Coke in 1979 when it was trading at 36 times earnings? Or Colgate at 34 times earnings? Now remember, the overall market back then was only on about 10 times earnings.
Wow. Okay, so you'd be paying a huge premium, 3.6 times the market multiple for Coke, almost 3.5 times for Colgate. Most people would say that's crazy expensive.
Exactly. You'd think you were setting yourself up for disaster paying that much. But even if you had paid those seemingly sky-high multiples in 1979 over the next 30 years, you would still have matched the market's overall performance.
Wait, really? Match the market despite paying 3.5x the starting PE. How is that even possible?
It's the magic, or rather the mathematics, of compounding. These companies, Coke and Colgate, they grew their earnings and intrinsic value so much faster than the average company. About 5% per year faster than the market over those 30 years.
5% faster compounding each year.
That differential rate of growth is incredibly powerful over long periods. As Einstein supposedly said, compound interest is the eighth wonder of the world.
And the letter illustrates that.
Vividly, it shows that just an extra 2.5% compound return per year over 30 years can literally double your final pot of money. So that 5% differential growth from Coke and Colgate, it meant their share prices multiplied 4 times more than the market index just through the power of compounding, offsetting that high starting valuation.
That is Genuinely mind-blowing. It completely reframes the debate about paying up for quality and growth.
It absolutely does. It suggests that for truly exceptional companies, the duration you hold them and their rate of compounding can matter far more than the initial price tag, within reason.
Okay, wow. What else did they use to argue valuations weren't necessarily excessive?
Well, they also did a direct comparison of dividend yields to bond yields, using Nestle as an example.
How did that look?
As of December 2013, Nestle had some bonds maturing in 2018 that were yielding a tiny 0.21%.
0.2%. Practically nothing.
Almost nothing. Meanwhile, Nestle's shares were yielding 3.1% from dividends.
Okay, big difference.
Huge difference. So the letter poses this pretty pointed question. Why would anybody in their right mind own the bonds rather than the shares?
Good question. I mean, bonds are safer, guaranteed return of principal?
True, bonds offer certainty of repayment, assuming no default. But given Nestle's track record, the letter notes only one loss-making year in its entire 146-year history. Up to that point, the risk of permanent capital loss in the shares seems pretty low.
So you had a choice. A near zero certain return from the bond, or a 3.1% dividend yield from the shares, plus the potential for that dividend and the share price to grow over time.
Exactly. From that perspective, the shares looked like much better value relative to the bonds, even if their PE ratio might have looked high in isolation.
They also bring it back to cash flow efficiency, right?
Yes, they reemphasize why they like FCF yield. They note their portfolio companies are generally less capital intensive. Their average return on capital employed was around 34%, compared to about 19% for both the S&P 500 and FTSE 100 medians. So their companies needed less capital tied up to generate profits, meaning more free cash flow for shareholders. That efficiency is a key part of the quality story.
Okay, so we've covered performance, the market weirdness, the portfolio moves, and that deep dive into valuation and compounding. But the letter also flagged a significant new development for Fundsmith back then, didn't it?
It did indeed. A move into emerging markets.
Now that seems like a big step. Fundsmith is known for focusing on developed market, high-quality liquid stocks. Emerging markets can be, well, different. Why was this move significant?
It was very significant. I mean, technically, about 32% of the revenues of the companies already in their main Fundsmith equity fund came from emerging markets. So they had indirect exposure.
Right, through multinationals selling there.
Exactly. But directly investing in companies listed in emerging markets, especially for an open-ended fund like their main one that offers daily buying and selling, that presented a big problem.
Which was?
Liquidity, or rather the lack of it. Many interesting EM companies just don't trade enough volume day to day to allow a large daily dealing fund to easily buy or sell positions without massively impacting the price.
Okay, so the structure of their main fund didn't really work for direct EM investing. How did they solve that? How did they square that circle, so to speak?
Their solution was quite clever, structurally. They decided to launch a completely new, separate fund in 2014 specifically for this purpose. It was called the Fundsmith Emerging Equities Trust, or FEAT for short.
An investment trust. How does that help with liquidity?
Well, an investment trust is a closed-end fund. It raises a fixed amount of capital through an IPO, and then that capital is invested.
So the fund manager doesn't have to constantly buy or sell the underlying stocks to meet investor inflows or outflows.
Precisely. Investors wanting to get in or out after the IPO just trade the trust shares with each other on the stock exchange. The manager can then focus on investing the fixed pool of capital in those potentially less liquid EM stocks without worrying about daily flows.
That makes sense. A neat structural fix. And what was FEAT going to invest in? What was the strategy?
The strategy was very much aligned with their core philosophy. The primary focus was going to be on consumer stocks within emerging markets.
Tapping into the rising middle class and consumer spending trends in those countries.
Exactly that. They saw it as a potential multi-decade tailwind for performance. Leveraging the same principles, quality companies, strong brands, repeat purchases, but applying them to the specific growth story in EM consumerism.
And were they confident they could find enough suitable companies? And what about governance risks, which can be higher in EM?
Good questions. They said they'd already identified an investable universe of over 150 companies that met their initial criteria. And interestingly, many of these were actually quoted subsidiaries or franchisees of the Western multinationals they already knew well and researched for their main fund.
Oh, I see. So that gives them a degree of comfort on the governance front, presumably. because the parent company provides some oversight.
That seems to be the thinking, yes.
Yeah.
It helps mitigate some of those typical EM corporate governance concerns by focusing on companies linked to established players they already trust.
Okay, that's a fascinating development. So let's try and wrap this up. We've gone through the performance, the market paradoxes, the portfolio logic, valuation, compounding, and the new EM venture. What does this all mean for you, the listener, taking this all in?
Well, I think this deep dive into the 2013 letter really showcases a remarkably consistent and disciplined investment philosophy.
Yeah, that focus on high-quality companies, sticking to your process, understanding the long-term drivers.
Exactly. And the detailed explanations they give for why they buy or sell something, it's incredibly valuable. Plus that whole section on compounding.
That compounding example is just fantastic, isn't it? It really makes you think differently about value.
It really highlights how patience and truly understanding the underlying economics of the businesses you own can win out over trying to time market cycles or getting spooked by short-term noise.
It reminds us, doesn't it, that sometimes what looks expensive in the short term.
Can actually turn out to be a tremendous opportunity over the long haul thanks to that relentless power of compounding. It really challenges that simple buy cheap mantra.
So here's maybe the final challenge to you, thinking about all this. The letter itself warns that maybe quality stocks weren't too expensive relative to the rest of the market back then, but perhaps both could prove expensive down the line, especially when interest rates eventually rise.
Right. Those character testing times again.
Exactly. And it then makes you reflect, how would you really have reacted if someone in 1979 suggested you buy Coke or Colgate at more than 3 times the market's PE ratio?
Most people would probably run a mile.
Probably. But in rejecting that idea based on the high starting multiple, you would have missed the chance to make nearly twice as much money over the next 30 years compared to just investing in the index. And that period included times of really high interest rates, too.
So the final thought, the question for your own investing journey is this.
Yeah.
Do you truly have the fortitude, the conviction to sit on your hands, as Terry Smith often advocates, during those inevitable rough patches?
Yeah, when rates are rising, when market dynamics shift, when quality maybe goes out of favor for a bit.
Are you prepared to trust the long-term compounding power of genuinely high-quality businesses, even when it feels uncomfortable in the moment? That's the real test.